Hello, everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. My name is Jesse Day, and we are bringing the VRIC to you each and every week with our series of expert online panels. Today, we have Melody Wright, the founder of M3 Melody Substack, and we have Jack Gamble, the host of the Nobody Special Finance YouTube channel. We're going to be honing in on the housing market and the general state of the economy in the U.S. today. It is great to have you both back on the program.
Thank you so much for having me.
Thank you, Jesse. Pleasure to be here.
Pleasure to have you both here. I want to start with a really broad question, and you can feel free to take it in whatever direction you'd like. And that is, what are the main themes and trends you're currently watching when it comes to both the housing market and the economy that you think more investors should be paying attention to? And Melody, I'll start with you.
Well, it's something you kind of mentioned before the show. Just big news last week with that Fannie Mae and Freddie Mac coming out and both taking massive provision for credit loss. I love the way they couch this, Jesse, in the media. It's, they put it like sorely on the shoulders of home price appreciation, saying they took the write downs because home prices were not going to appreciate as much as they thought. Now, what they're kind of hiding when they say that is that when you don't have insane home price appreciation, then you start to have defaults. And that's really why you're taking that provision for credit loss. And in fact, yes, we've seen those defaults rise. Delinquency is seasonal. And so we knew we were experiencing a little bit of an okay period after tax refund season and bonus payout, but knew that would start ticking up materially again in June, and it has done so. And so you're also seeing the banks increase their provision for credit losses as well. And what this signals to me is I very much remember the moment in time back during the last cycle and crisis when we had to stop saying home price appreciation, HPA, and started to have to say home price depreciation. And that was a big shock to the industry. And so although it didn't get a lot of press because a lot of other things were happening that day, I got to be honest, can't even remember what now. But it was something else, as is the case these days. There's some crazy, headline each day. And so people aren't paying attention. But there is a larger awareness that's about to occur.
And Jack, what's on your radar when it comes to the housing market and the economy in America?
Anytime we're talking about housing, you always got to go right to the job market, as that's the single most important input after interest rates and monetary policy. And I'm still reeling from the gut punch of the non-farm payrolls that we got last Friday. I mean, that was a shock to the labor market. Not so shocking to me, and I think some of the bears out there. I've been saying for years, this myth of the strong jobs market just doesn't hold water. We got a big dose of that. The Bureau of Labor Statistics wiped out 2 months of job gains in one fell swoop. And then, of course, the fiasco over the firing of the statistics person. Is that Banana Republic behavior? You got to wait and see who he replaces that person with. If it's a puppet or a yes man, then yes, it is Banana Republic behavior. But you can't argue that the non-farm payrolls was being accurately communicated, and it's just too important of a data point. So, we've seen this sudden surge of weakness in the labor market, and that obviously people lose their jobs, they can't pay their bills. We've also seen a several year-long trend of a loss of full-time jobs offset by part-time jobs and multiple job holders. And that's not good for the housing market. People who are door dashing or working part-time at a second job in order to pay the rent or to pay the mortgage, that's not sustainable over the long term. We've actually seen the number of multiple job holders start to tick down. And I think what that is people are now unable to find that second job. I've been saying for about 2 years that at least the silver lining is you can find that second job if you're willing to do that. At the very least, it's an option for people. They shouldn't have to, but it's an option. It looks like that may be going away. You're also seeing a surge of things like hardship withdrawals from 401ks. Article in the Wall Street Journal last week, 4.8% of workers are now dipping into their 401k to make ends meet. That's up from 2% pre-pandemic. That's a big problem. 1/3 of people who lose their jobs are liquidating their 401ks when they go. They're not keeping it in savings. So That means these gains in the stock market are partially keeping things like consumption in the housing market afloat. And then as far as the risk to the overall economy, it kind of falls along those lines of 401ks. I'm really worried about this push to democratize private assets, things like private equity and private credit holdings being put into people's 401ks. This private equity industry is as I often say, a wretched hive of scum and villainy. And these assets are not marked to market. They are grotesquely overvalued. These companies are zombies that don't cash flow. They've only been kept alive by private credit, which is loans, often from the same private equity firms that own the companies are now making loans to these zombie companies to keep them afloat. We passed this law, Dodd-Frank said banks aren't allowed to make these risky loans anymore because bailouts. And so the banks are like, no problem, we'll loan money to the hedge funds and the private equity firms, and then they'll loan the money to the firms that we're not allowed to loan to. And now that all this is done and it amounts to several $1 trillion, they're saying, well, crap, we got to get this stuff off our books before we have price discovery. Quick, let's dump it in everybody's 401k. And we're seeing that happen with alarming speed right now. President Trump is expected to sign an executive order allowing this. I think it's going to be a big mistake, and people need to know that that's coming out there. And, look, if the economy is being held up partially by hardship withdrawals and liquidations of 401ks, if we're going to start parking toxic assets in those same 401ks, that means that lifeline may not be there for a lot of people. So that's a big risk.
I'd like to shift to discussing the tariff policy. This kind of ties in with everything in terms of the various policies that the Trump administration has been pursuing, including the one you just outlined, which is certainly concerning. We've seen a lot of mostly negative reactions from media, both social media and the mainstream media, in regards to all of these tariffs being implemented. A lot of them are just threats. Trump likes to throw out the idea that I'm going to tariff you if you do something I don't like. And a lot of the time they ended up getting extended in terms of their deadline, or they end up getting reduced. But nonetheless, this is a policy that seems to be going full steam ahead. We've now seen additional tariffs threatened against Brazil, India, the entire BRICS nations group for supposedly circumventing the US dollar. There's a lot of that getting thrown around. On the other side, you have some proponents who say this is going to bring in much needed extra revenue, and Trump will somehow offset the extra cost that's passed on to the consumers by lowering taxes. I'm wondering how you both see this playing out and its implications for both the economy and the housing markets as well, Melody.
Yeah, so it's super confusing right now. We can't keep track. The taco, he changes his mind every day. And today's Taco Tuesday. I'll be having tacos tonight. And so, I think what I do is focus on the inevitabilities versus the tariff du jour, if you will, so in the housing market right now, the builders are not talking about tariffs because their problem at this moment is an oversupply, overhang, and they are dealing with a pipeline, over 500,000 homes in pipeline right now, the most since November 2007. And so their biggest issue isn't going to be the tariffs right now. It's whether they can get that, snake through, or the pig through the snake. And so I think that's a lot of the tariffs. We don't know exactly how they're going to play out. But in the near term, right now, we have even bigger problems to deal with. And I guess that's, the way that, and I look at, we're in kind of like a financial repression model where the politicians are limited in their options. This is why you saw them walk back this idea that they were going to force student loan borrowers into a new program that could potentially cost more than $500 more a month for each of these borrowers, because they knew exactly what this would do to the economy. So they did a lot of song and dance, but at the end they pulled it and they prolonged it till after the midterm. So I think this is a lot of these policies that they came in and said that they were going to do. We now see they're not going to do because they can't do it. And the options are just so limited. And so that's really what I've been trying to do. I love Jack's summary of everything, which was fantastic. And he has to live in the day to day. He has a daily show talking about this. I've kind of taken the position to just pull back and wait and see exactly what actually gets implemented before we can talk about implications, but think through what is the current situation and how is that in and of itself already problematic and how it's going to play out? I hope that kind of makes sense.
Yeah, absolutely. And the level of smoke and mirrors that's being played so far
Right.
by this administration on every single issue that they said they were going to handle or tackle is now being completely, I don't know, obfuscated, whatever that word is.
Correct.
But
Yes.
it's now being put in a situation where we don't know what actually is going to be implemented and not going to be implemented. And that
Exactly.
uncertainty, yeah, causes a lot of problems. Jack, your thoughts on the tariff policies and how you could see them potentially impacting the economy?
So I think there's a reflexive drive out there to just assume consumer prices are going to go up, that, oh, they're just going to pass those prices on to the consumer. And historically, that has been accurate, right? That's typically what happens when there's some big price hike, whether it's through tariffs, government intervention, or some private disruption. It's usually passed right on to the consumer. But we're in kind of a unique position here where the consumer is already pretty much broke, right? I mean, you've got 10% of the population that owns a lot of assets that's doing really well here. Those luxury goods, oh yeah, the tariffs are going to get tacked right onto those things. The rest of the population is really struggling. See earlier comments about hardship withdrawals from 401ks. It's not so cut and dry that those prices are just going to go up because people can't afford them. They just won't buy it. So I don't think there's enough pricing power to just automatically raise those prices for tariffs. And we're already seeing some of that. Japanese automakers, there was a report from the Bank of Japan a couple of weeks ago. The average Japanese automaker has actually cut their prices sold into the US by 19.4%. And now the tariffs have been 25%. So yeah, 5% of that got sent on to the consumer, but most of it is getting eaten by the producer, by the manufacturer, companies like Nissan. Same thing in apparel. Apparel companies have historically very tight margins, and you're talking about a consumer that is already cutting back. Apparel is one of the first things to get cut back on. There was a study that was done by the University of Delaware that said most apparel companies are actually squeezing their suppliers, demanding they eat the tariffs, not passing those prices on, again, because the inelasticity in the consumer, they just can't absorb it. So now that's two specific industries. I'm sure there are some things where the tariffs will get passed on, but it's going to be a case by case basis. It's not so cut and dry that it's just going to be automatically piled in there. And in the cases where those costs are not just passed on to the consumers, you could actually see a deflationary impulse from that, right? Like a company like Nissan, who's already struggling for cash flow, they're on the brink of bankruptcy. They can't cut their prices by 19%, but they also can't increase them. They're just going to cut production. And if they're cutting production, well, then they're laying off people. They're shutting down assembly lines. All of a sudden, fewer jobs out there, less consumer spending. So, a lot of the attention is on the inflationary impulse in the short term. In the medium and long term, it could actually end up being very deflationary.
We've got 3 of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on 2 outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
I want to talk about something that you touched on at the top of the show, Melody. You talked about both Fannie Mae and Freddie Mac. I want to hone in on Fannie Mae recently experiencing an income decline. Now, this is something posted on X. I got it off your profile. You had reposted it. It says a $946 million provision for credit losses in the period, which Fannie attributed to declines and expected declines in home prices. Could you break down this in a little bit more detail for us and what it means for the housing market?
Yeah, and just quickly, I want to just say, like, Jack did such a great job explaining what I was trying to say through my illustrative example is that the builders know they cannot pass these costs off to the consumer. So they're not even talking about tariffs anymore. They've got bigger fish to fry. So, but yes, going back to this provision for credit loss. So what happens when you are in these industries and you know that you are lending out to borrowers of a certain profile, you put in a lot of factors like what is a 10-year treasury rate, or what's the unemployment rate, or how many job openings, how many unemployment claims. And they have these big giant models that say, okay, with all these things at this level, you can expect these amount of losses. And so for a home price, what a home price appreciation environment does for these large companies is it glosses over any of that delinquency in the back end because you're still sort of able to gain from those home prices and make that margin and things like that. Well, once you are in a decelerating environment, a home price deceleration, a lot of things start to happen at once. If you think about how people like to stomp around saying there's no underwater mortgages, for all those COVID years, there were a lot of reasons for that. The biggest one is because home prices were appreciating, because, okay, yes, let's say you have a $150,000 mortgage on a $225,000 home at the moment, but 2 years go by and now that's at $350,000. And so you look pretty good from an equity position. Well, guess what happens when the opposite starts to occur? And this is very similar to what happened in the last cycle. In 2006, when I started in mortgage, those loan to values look great. That equity position looked great. Those credit scores look great. The next several years occurred and you start to see those underwater mortgages. And of course, we just saw a story recently about underwater mortgages increasing. And so what that headline about, we're taking this provision for credit loss, which means they have to take a little money, set it to the side on their balance sheet in case they do have those losses. This means that now in a home price environment where prices are decelerating, they know that delinquency is going to increase. Their costs are going to increase and things are going to get tougher from here. So they're setting aside this money. And this is on top when both Fannie Mae and Freddie Mac strategically sell off all of their delinquent loans to hedge funds. And so you got to think if they took such large numbers, which if you compare to a year ago period, they took a $300 million benefit. Okay. So for them to switch over a year and take a 950 something, almost $1 billion, provision, which is not a benefit, that was a massive swing. And it's showing you that even when they are selling off those loans, those delinquent loans to hedge funds, they know that losses are about to increase and that margins are getting compressed.
And Jack, would love to get your thoughts as well.
Yeah, I was very surprised to see that big provision, $946 million, excuse me. That's a big number, up from 24 million the prior quarter, from a negative provision or a gain of 300 million a year earlier. So obviously a big change. Most of that was in single family homes. 737 million of it was from single family versus 209 million for multifamily. That does show that it's both, the rentals and the single family homes that aren't doing so well. Look, the housing market's been just treading water here, slowly sinking. We could say, median home price has crept down a little bit over the last 3 years, but for the most part, it's still frozen in place. There's no liquidity. There's very little inventory, although we're watching that inventory climb. Melody could probably give you this number. We're somewhere around 9 months of inventory now, where we were like 3-4 months for several years here. I mean, there is a lot of negative impetus that could push this housing market over the edge. And in an illiquid state like we're at, it won't take much to bring those prices down substantially. I think Fannie and Freddie are seeing this now. And what is the positive? What's out there besides rate cuts? Well, like what's out there that's going to drive housing higher from here? It sure as heck isn't the jobs market. It sure as heck isn't liquidity in the bond market. There's any number of things that could go wrong over there. So absent rate cuts and the Federal Reserve coming in and starting to buy up mortgage-backed securities again, I just don't see anything that could take this housing market higher and a lot of things that could bring it lower.
Well, Melody, I want to hone in on something else you posted on X recently, another data point. You said the massive surge of new apartment supply in the last few years is still being absorbed, and that has vacancies rising and rents weakening. The national multifamily vacancy rate rose to 7.1% in July, setting a new record on Apartment List's monthly index. So how does this particular data point fit into the bigger picture?
Yeah, and brilliant segue as kind of Jack just mentioned about the multifamily. So the agencies also lend to multifamily operators and they're taking provision for credit loss there. We knew there was going to be a problem when you had more apartments in pipeline since the 70s, and we didn't have the demographics to support it. And so basically what you're seeing is people were talking about this housing inventory shortage, which is really, it was kind of a misunderstanding of the housing inventory out there, a misunderstanding of the current state of how real estate transacts. And so they went and they overbuilt. They overbuilt thinking, you know, everybody on the apartment side thought, well, you can't afford a home and rents have been rising. So, you know, we need to build more multifamily out there. Well, at the same time, you had the builders for the single family residents going crazy building these new homes. Well, how does this matter? Well, you know, rents were going up like crazy in the early days of COVID, but those have now moderated. And in fact, in same store, depending on what series you're looking at, we have started to see declines. And now this will be more impactful, and Jack can probably talk better to this in terms of how this shows up in our inflation metrics, because kind of the last outlier out there has been housing costs. And so as that turns over, because again, we just simply built too much, you know, the average household size right now, people think it's around 3.5 or 4 people in the United States. It's actually 2.5. That's how much housing we have. So really the housing market's become about speculation versus, you know, housing for you and me. But those inflation metrics are about to show deflation, and due to things like having so many apartments, that vacancy rate is going up.
And Jack, how do inflation metrics play a role here when it comes to this surge of apartment supply?
So the way we measure housing inflation in the Consumer Price Index is just so deeply flawed. We use a statistic called owner's equivalent rent, and it's the largest single input into the CPI calculation. CPI is made up of hundreds and hundreds of data points, and then they average them all out, but they're also weighted. And 24% of the index is a single statistic called owner's equivalent rent. Nothing else comes close. And the way they collect this data, I kid you not, they call people out of the blue and they say, how much would you rent your house for unfurnished if you were to put it on the market today? And they don't give people any time. They just poll people randomly, unscientifically on the phone. People don't have time to check the comps. They don't have time to check, you know, what's things going for on Zillow, what's my house worth on Redfin or this or that. What they typically do is they just spout off their mortgage payment plus $100 or plus $200. That's what most people will answer if you call them up. And so that's not accurate. I mean, we're seeing asking prices come down for homes on all of the real estate websites. We're seeing asking rents start to come down. Homes are spending longer on the market. Obviously, housing inflation is not as high as it was years ago right now. It's not to say prices have come down much, but they've definitely stopped going up. And it's just a very deeply flawed statistic. And, you know, let's tie in the other conversation we had earlier about the non-farm payrolls. The two most important data points that we use to measure our economy, the non-farm payrolls and the CPI, are not working right now. And look, Fed's dual mandate that they use to set monetary policy is maximum employment and price stability. And the way we measure employment and price stability, both are not working right now. So do you think maybe we might have some misallocation of capital going on in the economy? You look over at the AI bubble and hundreds of billions of dollars being spent on data centers that don't make money. Do you think maybe we might be misallocating some capital based on flawed math? So, you know, this data is way too important here. And Melody is right. The way we measure housing inflation is deeply flawed. And this whole narrative of the housing shortage that the question was based on is just bunk. We don't have a housing shortage. The number of housing units per capita in this country has been rising for 7 years in a row now, right? Prices didn't go higher because of a shortage of homes. Prices went higher because of a shortage of people who could afford those homes. And people can't afford those homes because the job market is not strong and because the government keeps pumping easy money into the housing market through all these various schemes with the central bank and with HUD and everything else and FHA that they're doing. So the solution here isn't to put people in little pod houses or build little sheds that we call tiny homes and cram millennials into that and say you're welcome. The solution is to let the prices come down like they want to.
I want to end on discussing the government debt and deficits and the action or lack thereof that is being taken to address them by the government. I'm going to flip the script and go to you, Jack, on this one first. And obviously we had Doge was the big thing when Trump first took office. We had Elon, we had Vivek. I don't see either of those guys talking about it anymore. Obviously, Elon is now fallen out with Trump. That's a whole other story. But there was this promise, like so many promises that evaporated, of getting debt and deficits under control, eliminating wasteful spending. And they did take some actions. They did do some good. I don't want to act like they did absolutely nothing. They did do some things, but it's a drop in the bucket compared to what needs to be taken. And now you have, this big, beautiful bill getting passed. You have the military budget rising to $1 trillion in 2026, a 13% raise. And a lot of other things that seem to show that the government is willing to spend as much as it ever did, or maybe even more. Where are we in this situation? How long can this can keep getting kicked down the road? It's, you have different schools of thought on this, because I speak to a lot of people who say, the economy is going to collapse tomorrow because of this. And usually those people have something to sell you, it should be said. And then you have other people who say, look, this can go on for way longer than people think it can. And of course, society and a lot of people will suffer along the way, but we're not going to see some catastrophic collapse, hyperinflation or anything like that. How do you view things as it currently stands when it comes to U.S. debt and deficits?
Doge managed to cut $11 billion. That was the sum total of all the Doge recommendations that were actually codified into law by Congress. I think that's enough to fund the government for like 14 minutes or 49 minutes. Don't quote me on it, but it's measured in minutes, not in days. All right. I mean, Elon Musk lost more of his personal wealth with market cap destruction at Tesla than he saved the government with what he did at Doge. I mean, Tesla lost hundreds of billions in market cap because of the political blowback for the $11 billion in cuts that they did at Doge. And, I'm seeing stories right now about, they defunded NPR, and all people in rural communities depend on NPR for news. Like all the farmers are just crying out that they no longer get NPR and they're without their news now. I don't, you guys know many farmers who get their news from NPR? I don't, but the hysterics around this pathetic $11 billion in cuts was comical. And while that was going on, we're doing all these other things like increasing military spending elsewhere. So the debt problem is getting worse. It's getting better. Like, the fact of the matter is, guys, we have zero political will in this country to address our spending problem. None whatsoever. All right. We have one party that campaigns on cutting spending and then time and time again does nothing about it when they get in power. And then the other party just wants to spend more. This problem's not going away. It's going to get worse before it gets better. We've got Secretary Bessent at Treasury right now is trying and failing to term out U.S. debt. He's trying to break Janet Yellen's over-reliance on the issuance of short-term Treasury bills instead of long-term 10, 20, and 30-year bonds. He has not been able to do that yet. He's failed, so he's doing the same things Yellen did. We've also got, what else is going on? The TGA has to be refilled, the Treasury General Account. We finally raised the debt ceiling. In 2023, after we raised the debt ceiling, the government had a surge of borrowing as they refilled Uncle Sam's checking account. That took interest rates, to near 5% on the 10-year yield when that happened. They haven't even begun to do that yet. So there's going to be hundreds of billions of additional borrowing this year just to refill the Treasury General Account. Secretary Bessent has been reluctant to have those giant bond auctions because he knows there's not enough demand to fill them. He doesn't want to blow out borrowing costs. They're relying on stable coins now, like the Genius Act. And the belief is that by putting a regulatory infrastructure in place for stable coins, people who are buying crypto will buy stable coins, and then the stable coin issuers will put that money into the Treasury market as a source of liquidity for the government to borrow. And I think they're probably leaning a little too heavily on that. Yes, that will result in new money flowing into the Treasury market, but it also brings with it new risk. Crypto winter is arguably just a few months away. Typically, it starts about 18 months after a Bitcoin halving. That would be roughly October of this year. And historically, we've seen big drawdowns in crypto when that happens. So we've kind of created the situation where a collapse in the crypto market could actually stress Treasury liquidity. And we've created a mechanism where it could spread to the bond market. So that may not be all good if we've done that now. So I guess long story short, Jesse, there's just not enough gold in the world for what's coming when it comes to the U.S. debt problem. I mean, when it boils down to it, you better own some of the shiny.
Yes, I completely agree with you there. Melody, your thoughts?
Yeah, so I would agree and just kind of emphasize something I said earlier is that, focus on the limitations right now. Like Jack is saying, yes, of course, Besant does not want to be like Yellen, but he doesn't have many choices. And I think, there was a lot of hyperbole in the media. There was a lot of, chainsaws gearing up and I call it kayfabe. This is WrestleMania. That's what our political system is, and they're hoping everybody's watching this show, but in reality their options are limited. I get hate all the time when I say they're not gonna, it's very unlikely they're going to try to claw back and garnish wages for student loans. Again, if they do that, people stop spending money and our economy is based on consumption. And so their choices are just severely limited. So I would encourage everyone to stop watching the kayfabe and think about what could really actually be done here. And unfortunately, as Jack says, they don't have the political will. It's going to take some sort of emergency. And I agree with him as well on the stable coin. Sounds like a great idea. In theory, we know the entire Eurodollar market needs those treasuries, to pledge them as collateral. But again, there's just no more gas left in the tank, and you can keep going for these very, obscure places in the market. But in reality, we've just run out of places that will be able to legitimately kind of solve this problem. And so I just encourage folks to stop reading the headlines and just think through what actually could be done right now. And honestly, start getting involved locally, because when all of this stuff does fall apart, as Jack is alluding to, and why, we all want to be owning gold, it's going to matter more where you live. And so you need to get in there and understand the dynamics you're working with right now, because I think things are about to get pretty real, no matter how much candy they put in the system through the BBB to whomever. Again, we're just kind of running out of options to sort of save this thing before it sinks.
Well, tell us about the M3 Melody Substack.
On that jolly news, yes, you can find me on at M3_Melody Substack. That's where I write about the macroeconomy and housing, and M3 Melody on X Twitter and M3 Melody YouTube.
Great. All of that will be in the description below. Jack, tell us about Nobody Special Finance.
Nobody Special Finance is my channel on YouTube. I'm also on Spotify. We do a morning show every day at 9 a.m. Eastern Time. Just typical finance news, everything happening in the market. And I'm also on Twitter at JG_Nuke.
Great. That will all be in the description below as well. This was a blast, guys. Thank you both so much for coming back on the show.
Thank you so much for having us.
Always a pleasure, you two. Thank you.